of the market that he has seen and the kind of transition that's playing out in the new India today. He's actually witnessed to all of that with his experienced perch. Ramesh Damani, thank you so much for your time today and wish you a happy Diwali.
Thank you. Season's greetings to both of you, and may the next year be very good for both you and your viewers. Thank you so much for having me.
Thank you. So Manish, first the wisdom.
Ramesh.
Ramesh, let's first talk about the wisdom then, and we're going to talk about, of course, what will create wealth later. What's the wisdom side of you currently telling you? Because, you know, if you look at the index, nothing really has happened. FIIs have not come back. But the government machinery and the RBI, they're all, you know, going all guns blazing to try and prop up demand coming back into the economy. Good time, you think?
And they've done a good job. I think one of the mistakes investors make is to look at this artificial construct and see the returns from April 1 to March 31st. And it's been a flat year, it's been a bad year. But the underlying is so strong in India, the gains are so fabulous in the last 4 years, that I think if you look at over a 4 or 5 year picture, I think you're doing just fine. So I think you should avoid the mistake of trying to look at it at an artificially created snapshot, which is April 1 to March 31st, and if the index is down, oh, we've had a bad year. We've had a great year. We continue to have great years, I believe.
So there have been successes, right, in that sense. Means don't look at the indices, but there are stories which are played out in the last 1 year and they've made returns for you.
That's been always true. I mean, you can always see that in the market. Remember the 90s bear market, we got birth to a company called Infosys and Wipro at that time, and Reddy's and Cipla, you know. So they've always been a good stock pickers market. And what you said is very important, that picking stocks is very important. There's a lazy way is man to riches by an index fund, and which is fine for people who don't have the time because they're involved in their own business or for whatever other reason. It's fine to do that. But if you want to get rich and you want to make a meaningful difference to your portfolio, you need to be an active stock picker.
But Ramesh, you know, that of course is a confluence of earnings, and it's a confluence of growth. Where do you think the next profit pool is going to get created? And I'll tell you why I'm linking this to the markets right now, because the market started getting into that consolidation phase when earnings petered down, and you did have a slowdown about 2 quarters back.
Yeah, I mean, people are looking at a few quarters, you know. I'm looking at what has happened is after Donald Trump got elected, in my view, is the world changed. And it moved on its axis. And what we are seeing is back to the 1980s almost, where it was state-directed capitalism. State was directing funds and equity to various places before the so-called Washington consensus took over, free markets, liberalization, deregulation. That took place for 40, 50 years. And now we're going back to state-sponsored capitalism that China has pioneered. For example, in the 1980s, when Japan was at its peak, they used to have an industry called the ministry called the MITI, Ministry of Industries and Technology. It was directed capitalism to consumer electronics, to cars, to heavy machinery, whatever. But that didn't work out, because what happened was they made the Walkman, but they didn't make the iPod, or they didn't make the iPhone, because it really works. But whether we like it or not, we're going back to that era of state-sponsored capitalism. So we come back now, step back and look and say, why has the PSUs worked so well in the last 5 years in India? Because it's state-directed, state-directing capex, state-directing expenditure in defense, in shipbuilding, in construction, which is causing that. So to answer your question, what will happen over the next few years? I think the leadership in the market has already been proved, A, with the public sector stock, 2, with, say, the capital market subsidiaries. They will continue to propel the market higher, I feel, because the earnings growth will be there, the huge capex push that the government of India is still doing on these stocks. So I think you stay on the similar horses. I don't think the courses have changed so far.
If you look at the entire kind of capex cycle which you spoke about, and it's being led by public sector companies there, right? So maybe if you look at this Diwali and you want to construct a portfolio for the next 5 to 10 years, which are the sectors or place that would be prime for that growth?
Yeah, a great question. I think what led the market, the PSU basket so far, has been, say, defense and railways and a few other stocks. We are now shuffling the pack. As a big believer in that story, I'm shuffling the pack. So let me give you 3 constructs that you can look at. There's a great push by the government for state-directed capitalism towards rare earths. It's a national priority. It has to be found, has to be self-sufficient in it. So whichever Indian public sector companies that are investing in the rare earth business are probably a good place to look at, because there's a large amount of capex and excitement in that area. The government has decided in its wisdom that India is going to be a maritime power. So we should have shipbuilding prowess in India. Huge amounts of money will get into shipbuilding in India because India's 90% of trade is carried on the waves, as they pointed out. So I think that shipbuilding sector will do well. And the other sector that will do well is government leads a lot in construction. So if you look at Delhi, as I pointed out many years back, Delhi was built in the 1950s when the Raj land was not at a premium. So it was horizontally built. But what the government is now going to do is build it vertically. Look at the opportunities that creates as you destroy those colonies and rebuild those colonies vertically in financing, in infrastructure, in construction. So those three verticals, particularly within the public sector, defense will probably continue to do well, particularly those involved in aerospace, drone technology, missile technology. But those are the broad sectors we're looking at. You know, the market will provide a lot of pickings in that area. So a lot of people feel that because they've run up, that they've now peaked out. I somehow think they have a lot more legs.
So the likes of BHEL and SAIL may not be the kind of flavor for the next couple of years, but it could be the HALs and the BELs and other companies which will be the flavor.
You do a better job than me.
Because at some point in time, you were very bullish on these. Means maybe a decade back, you know, you were one of the early pickers of some of the PSU stocks.
I remain bullish, as I mentioned to you. I remain bullish. I think there's opportunity there. Because what has happened, let's see, sometimes you have to live life forward, but you understand it backwards. You understand that what the market favored was the state-directed capitalism. It's happening in America. For example, Donald Trump is putting money behind Intel and putting money behind Molycorp with rare earths. It's happening in China. It's happening in so many other countries in the world. It's happening in India too. So where is the government expenditure, the capital expenditure going to come through the public sector arms that it has? And that has caused the whole excitement. You know, when you were buying the defense stocks, for example, 5 years back, they were trading at multiples of 5, different deals of 5 and 5-year order books, you know, so they were that cheap out there. So market tends to swing in pendulum, so it's gone from one extreme to love, but it's probably got to swing some more ways to the right, I believe.
Ramesh, the US has been, and since you track the US equity markets also very closely, it's been all about the Fab 7, right? That's where the chunk of the wealth has been created. Is there merit in even drawing or trying to draw a comparison here, whether India will have its set of Fab 7 and whether that will be all tech-led?
We probably don't have a Fab 7, to be quite honest with you, but we have a good domestic economy, 1.4 billion people, demographically in the sweet spot. So we'll continue to find great opportunities in India to invest, in my opinion. And, you know, my feeling by interacting with promoters at AGMs or meeting them or going to analyst meet is there's a underlying optimism about business conditions in India. So I think there are lots of opportunities in India. Maybe not AI specific, though AI will, of course, change the world and will change America for sure. And India will have a lot of use cases for AI. But in terms of actually rolling out products for AI, we might be behind the curve.
Interesting, you know, the IT sector has been has lost nearly 20-30% since the beginning of the year, and the narrative has been the AI as one of them because we are behind the curve on that. Do you see evolution of the Indian IT sector as well, and fast catch up to this entire AI race?
I think it'll happen. I'm not really. AI is such a fast evolving area that I'm not up to speed as to who wins and who loses in AI. But I figure there'll be a lot of demand for people doing systems integration, people doing services around AI, which would require, it's not that you can just plug AI and have it go. You know, you need system integrators, you need people to write, at least check the codes, do that kind of stuff. So, you know, I think AI will be fine, but, you know, it's obviously going through a tough patch.
So defense clearly is one space, and, you know, the larger umbrella that you talked about. You also talked about the very rightly Delhi example as to how, you know, infrastructure in the next 2 decades perhaps will be very different than what we're sitting at right now. What else as a decadal theme do you think is going to play out in this new emerging India?
You know, actually, surprisingly for me, I found a lot of interest. I find a lot of my portfolio interest in pharma shares, which has been, after all, it's a long, torturous journey for me to find value in pharma, because I missed the first leg of the Reddy's and the Ciplas of the world. But increasingly, I'm finding Indian companies making novel drug applications, which will make one class of drugs themselves, buying ANDAs, developing intellectual property, which I think will, or developing, you know, equipment that will enable drug delivery. So a lot of companies are there in that area. So I find myself increasingly making a lot of bets in the pharmaceutical sector, and not necessarily among the majors, which will continue to probably do well.
Sure.
but on companies that are actually doing some intellectual property which is like the first for India, basically.
Including the CDMO space?
I mean, that will do well. I have a few exposure to that, but I'm more interested in people who are actually filing patents, buying ANDAs, or have facilities in overseas rather than just in India. I think they will all do well.
And you see a lot of pharma companies going global in terms of to hedge their positions with respect to the kind of capitalism, the government capitalism which is coming into play.
I think so. They're doing that, and this generally in the range of maybe a few thousand crores to 10,000 crores, in that range. I'm finding a bunch of attractive pharma companies that I'm willing to hold, be patient and hold for 3, 5, 10 years perhaps out there, because they're run by good promoters, have a good business sense, and are doing exciting things.
And how do you see the asset classes actually? Equities is one which you're playing. You have gold and silver, which is now the favor of the month or favor of the year, and we just saw
which is making equities look so bad right now.
And sovereign gold bond redemptions that happened yesterday at 338% returns, and that excludes the yearly interest which has to be paid as well. How do you see gold, silver playing out?
Yeah, great question. Thank you for asking me that. I think if you're a trader or a speculator and you miss the gold rise, as I did, for example, you have a sense of FOMO if you're trading or speculating. But if you're an investor, Warren Buffett once famously said that if you own an ounce of gold and hold it to eternity, when eternity did arrive, you would still have that 1 ounce of gold.
Yeah.
So let me give you an example of that. In 93, if you bought an ounce of gold, it was like $400 an ounce of gold. At the same time, you invested in an IPO of a company called Infosys. You bought 100 shares for 9,500 rupees. It came out IPO of 95 rupees. Today, that 100 shares of Infosys, that gold is still 1 ounce, 40 years later. But 100 shares of Infosys, how many shares have it become? Can you take a guess? How many shares of that 100 shares of Infosys with splits, bonuses, how many shares has that become today? This is, I think 30 years later. Take a guess. Well, I'll tell you this thing. It's over 3 lakh shares,
Okay.
Aisha. It's over 3 lakh shares, the amount of bonuses and splits that 3 lakh shares. But here's the math that gets crazy. The 3 lakh shares at 1,500 rupees a price, give or take a few bucks, is worth 45 crores in your portfolio. So that 10,000 has become 45 crores. But that's not even the most exciting story. The most exciting story is that every year you get a dividend on 3 lakh shares of 1 crore 25 lakhs. Every year on the 10,000 investment, the return on capital is 1 crore 25 lakhs. I can't even do the return on capital invested in that share.
I don't know how many zeros that will come to.
But the point I'm trying to make is that sometimes all that glitters is not gold. It is stocks. And I think it teaches you that stocks should be, it's important to get stocks right, to pick stocks, to hold it for a long period of time and to see businesses mature over time. So I'm saying that, you can say very well that, well, gold has done well in here. It has done well. And if you're a trader or speculator, obviously you should have been in gold out there. But if you're not, there's nothing to fear. That if I were investing for my grandchildren, as I do, Veer and Arna, who are 8 and 6, I would be buying them common equity because that's where maximum appreciation happens over a period of time. I think long-term CAGR for gold is about 3%. Long-term CAGR for, in dollar terms for US, for Indian equity is about 10, 11%. Where would you want to put your money if you're looking at a 10, 20-year horizon? It's a no-brainer.
So for the grandchildren, does the portfolio color change? Is it more the new age consumer tech companies which are part of now our day lives, and one wonders, how did we ever function without them?
Not really, Aisha. I mean, I think that something has never changed, that you want to buy things that are cheap and with a margin of safety and which have good potential out there. So I want to buy stocks, first of all, that are cheap. I have a passion to buy them. Whereas my mother used to tell me, you want to buy things cheap. And I have, continued to do that. And if that comes in pharma shares, for example, comes in public sector stocks, or comes in the new name consumer stocks, I will do that. So my first criteria is obviously that, is there a price I'm willing to pay for that business, which I think they're throwing away the business at? If I do that, then I'm ready to wait 10, 20 years. And they will go through bad periods, the volatile periods. Of course they will go through. But, you're looking for, particularly when you're investing with children or grandchildren over a 10, 15-year horizon, when they get to college or when they get to marriage age, when you want to encash some of the winnings in the portfolio. So you have a long runway ahead for most people. So you want to look at businesses that are cheap, but are run by good people and have integrity. And you feel over 5, 10, 15 years, they will build considerable value, which I think there's considerable businesses in India today that even today, despite the heady run-up, the index going from 20,000 to 80,000, you will find that you're willing to hold for 5, 10 years. through periods of volatility. I'm not saying there's a linear rise. It never is. There'll be periods of volatility. But I think, I mean, someone, as I famously pointed out in my example, when my kid was 8 or 10 years old, gave him a gift of HDFC Bank, and look how much value that has created for his portfolio. And that taught me, taught him, and taught a generation of investors that when you're young, you want to invest in appreciating assets or not depreciating assets. Because appreciating assets, if you bought the right stock like HDFC or HDFC Bank, they multiply your money 30, 40, 50x, maybe 500x. Whereas, a toy, a gift, clothes, cars have all depreciated value.
So for Ashok, it was HDFC Bank, Veer and Arana, right?
Arana.
What's the stock for them?
I wish I could discuss stocks publicly. I can't. So unfortunately, nice try, Aisha. But I think as a rule, almost every birthday we try and buy some stocks, and generally not try to sell them. So real estate will probably do well over the next 5, 10, 20 years. I mean, people are going to real estate. So you find, you can find bargains, and as a basket approach, maybe one or two will really take off if I'm lucky, like Infosys, and others maybe will flounder, but that's okay.
Ramesh, if you look at platform companies, and people argue that these are the companies for the future because we are going to food tech, the newer generation is going to use them a lot compared to the older one. How do you look at the platform companies? Is profitability is a factor at, when you say that buy cheap or where now, and maybe these are the business for the future? Do you think that there is enough of play for these platform companies going forward?
I'm not sure which ones you're referring to, but
only 3 or 4 ones which are there, right? Means into quick commerce or food delivery and others.
Yeah, I mean, are there survivable businesses, say the food delivery businesses that are now so rampant? Yes, I think the business will do well over a period of time. Do I find them particularly well valued right now? I probably don't, but I'm probably in a minority because the market has a lot of interest in the stocks. Yeah. But these businesses will do well, I have no doubt about that. I like to buy things cheap. I can't help that. So I want to look for a better entry point for these companies. See, to me, what 30 years of experience or 40 years of experience in the market has taught me is that you can do trading, you can do momentum, you can buy and sell tomorrow, which is fine. I do all of that. But the long-term investments are looking for businesses that are cheap. You want to buy things when they're cheap. And they're certainly not cheap. I mean, even if you look at, people make the mistake of thinking growth and value are two different, they're the same thing. Growth is just a component of value. So, am I buying them now? No. But am I holding them? Yes.
When was the last time you identified something cheap and bought?
I mean, that's my job all the time. I mean, for example, if you go back, say, to when COVID started, we bought all the defense PSUs.
Of course, yeah.
They're up 20, 30x out there. We certainly bought a couple of consumer names in the watches business that are up 10, 20x from that price. So, it's almost a daily routine. And Aisha, I have one big advantage over the other fund managers interview and other people. I run my own money and my prop money.
Yeah,
so
you're not questionable and answerable to anyone.
No one gives me a hard time when I underperform. The fund managers do that. So I can take a risk view, and sometimes the stocks, when you bought, say, United Spirits in the 2000 bull run, it didn't perform for 3 years, and other than grief personally, I was okay with it. I had no public to answer to. When they went up, of course, I celebrated along with the rest of the crowd. So I have an undue advantage, I must admit that.
And when do you sell them actually? Or do you don't sell them at all?
No, we do sell them. I mean, I'd rather get to the Zen-like state where I don't want to sell. I can hold a business forever, as Warren Buffett says. I haven't reached that yet. So I get rattled once in a while. In the defense correction, I got rattled. I sold some of the defense PSUs. I mean, you do get rattled. I mean, it's a market, you're a human being, so you will get rattled.
Which is the stock that you've held the longest?
Yeah.
I mean, if you can disclose that.
I think I've held a company in South Finance, Sundaram Finance, for donkey's years. I think I've had Lever for 15, 20 years. I think a lot of my core investments I've been holding for 15, 20 years.
Another sector which you spoke about briefly is the defense one, which is, you said, it's a decade back, they were available at 5, and now even, and at that time the book was 5 years for them. Today also the book is 5 years for them, but they're at least 10 times that multiple which is there. Do you still continue to have faith in the kind of multiple and the growth story for them? Because at the end of the day, the biggest customer or client for them is the government, right?
I think it's the government, but what is changing, I think, is that increasingly they're becoming export-oriented businesses.
Yeah.
A lot of the technology, for example, in missile technology, we'll export to Philippines, Indonesia, friendly neighboring countries. So there's almost unlimited demand coming for that generation of companies. Shipbuilding, India can become, we have everything needed to be a shipbuilding power. We have a long coastline, we have a workforce, and basically shipping is nothing but welding. You just need to weld. So you have enough welders.
And the recent, the fund which has been introduced.
There's a fund being used, and that India, now the government directs that we want to become a shipbuilding power. I think we're going to become a shipbuilding power. So I think there are lots of opportunities in that defense area, because the listed plays are largely defense and shipbuilding, and a few non-defense plays, but there are some plays.
Another area which you were very bullish on in the MNCs. They used to be here and they used to be good dividend players, but now we are seeing a lot of global parents listing their Indian arms.
Yeah, I know. Life
and
has
they're
come
getting
full
much
circle.
more value than what the parents have actually.
Yeah, life has come full circle. I can't imagine MNCs listing in India and taking money out of India. And I think there's a lot of excitement among MNCs about listing in India with the rich multiple that they're getting. But I think it's a good thing if someone like LG or Hyundai lists in India. I mean, the value creation and value discovery is another process. But I think it's great for Indian investors. I think I've always wanted since 1990s. I wish Coke would get listed in India. I wish, some of these snack food businesses in India, because I enormously like these businesses that would get listed. I think it's a great achievement in Indian capital markets that these companies are thinking and finding better value in India than they're finding, say, perhaps in their own home market. And I think it's great for Indian investors. Some of these businesses look very attractive to me.
Ramesh, much like investing is about what you should own, it's also about what you shouldn't own. And since you did talk about Infosys, are traditional IT services play the bygone era?
I wouldn't say that. I think it's a bit premature to, it's like Mark Twain said, rumors of his death have been largely misstated. I think, we'll give it time. They're going through a tough period. They'll probably figure out which business model works. Aisha, it's always been about stock picking. It's not really about buying a sector or not buying a sector. So the only thing we don't want to buy is fraudulent companies or companies that are,
Sure.
promoter run or something. Decent business we're willing to look at. So I won't write them off yet at this point.
Which is the sector that you would like to avoid at this point in time? Is there a sector which is overbought territory for you?
I can't say that. I mean, I'm sure there are, but I'm saying just in the way I look at the markets, what I've been buying is buying some public sector stocks which are concentrating the themes that you mentioned. We're concentrating some on the pharma companies that I mentioned. I have a well-diversified portfolio. I don't run a very concentrated portfolio like some of my contemporaries. I run a well-diversified portfolio. So I have a lot of exposure to FMCG, a lot of exposure to tech. I look at what I tell people is that you should look not at portfolio level returns. We're basically trying to put money to double every 3 years. Okay, so within that you'll make a lot of mistakes. But if the aggregate portfolio doubles every 3 years, you're doing fine. So I don't necessarily run a portfolio. I say, I think consumer is going to underperform, so I should not avoid consumer. I have a lot of consumer stocks in portfolio. They underperform. But over time, these businesses will tend to do well because they've been purchased at the right price. So Lever hasn't performed the last 3 years, but I still own a good quantity of that.
The power of compounding.
The power of compounding, that's the trick to the life trick, the magic trick in Diwali.
Stay put.
Buy cheap and stay put. I think you put it well, Aisha.
What about capital goods, or renewables? Are you exposed to that?
Capital goods, yes, of course, through the government exposure to PSU, all of them.
And renewables?
Not particularly. I don't really.
You're not so gung-ho on renewables?
I don't have any exposure, any tremendous
What prevents
exposure.
you from going and taking an exposure?
There are only so many sectors you can cover. So, I've covered, it's done well. I think stocks have done well in that sector. I wish I would be a part of every winner, but that doesn't happen.
Buy what you understand, as Buffett says.
I think
right?
you could give a masterclass today. I think you're coming out with all the right statements. Yes, absolutely. Buy what you understand. Stay within your circle of competency.
Yeah, exactly.
And what you need to know is your area of competency or the edge of that competency.
And you can't have everything.
You can't and you shouldn't.
Yeah.
I mean, I think it's just too much. Within that, I also run a fairly diversified portfolio. So I'm okay if I cover 8 sectors, and broadly, if you can double your money every 3 years, which is what my gold standard is, I think you're doing a great job. It doesn't matter if you miss. So what? I mean, Buffett didn't buy any of the tech stocks and he did fine without it. So it's fine.
And he got so many of them right as well,
And
as did Ramesh Damani.
and the important thing to remember, Aisha, is that 99% of his wealth of Warren Buffett was created after he was 50 years old. I think he was a
Yes.
billionaire at 50,
Yes.
and then 99% of his wealth is created after he was 50. So I'm just getting started.
So live long, live healthy, and thank you as always for
And
your
happy
time.
Diwali to you.
Always a pleasure, guys. Thank you so much for having me this morning.